A cooling UK jobs market keeps the Bank of England on track for a November rate cut. Welcome to Market Insight. I'm Ramzan Karmali. British pay grew at its slowest pace in more than 2 years in the 3 months to August, and vacancies fell again. That's likely to give policymakers at the central bank confidence to ease rates next month by 25 basis points. And markets are currently pricing in around an 80% chance of that happening. But are they right? Well, to help answer that and more, I'm joined by Ed Legget, UK Fund Manager at Artemis. Ed, thanks so much for joining us. So does this latest data give the Bank of England the green light to cut rates on November 7th?
Well, the data this morning was very much in line with City expectations, and indeed, as you rightly stated, wage inflation is coming down, and that's what we'd expect because wages lag inflation. They lagged inflation on the way up, and they're lagging inflation on the way down. And I think, given the moves we've seen from the Fed in the US and from the ECB in terms of cutting rates, we'd certainly be in line with the market's view that we've got another rate cut coming in November.
We also get the overall inflation data out tomorrow. What's a reading that is going to ensure that that rate cut isn't blown off course?
I think people will very much focus on the core inflation number. And that's the big unknown. And I think when we think long term about where UK rates will settle, you've very much got to think about where long-term wage inflation settles. And we've had a lot of uncertainty in terms of emigration at post-Brexit. We've had a huge rise in the living wage over the last few years. And we've, those two things together have created quite a lot of uncertainty about where wage growth will settle as inflation normalizes, and inflation, is now back close to the Bank of England's target. So that's medium term. That's what we think about. As I say, in the short term, we do think the bank will cut rates. I think unless we have an enormous surprise on core inflation tomorrow, we'd still expect the bank to cut rates in November.
One unknown, though, is the budget, though we are getting quite a few hints, one being that there's a possible national insurance hike on the way. If that's right, what do you make of such a move?
I think when you look at the black hole in the budget that they've described, the 22 billion, we'll have all read about 100 times now in the newspapers, and you look at the taxes that they said they would fix or wouldn't change as part of their pre-election manifesto, then the range of taxes you've got to raise 22 billion across is very small. It's about 25% of the overall tax take. So to raise 22 billion pounds, you need to move some of those taxes in an awful long way. And I think as they've gone through the different taxes and looked at what they can do on those individual taxes, it's all creates too many other uncertainties about CGT. Will you raise that money, or will people just defer when they take their capital gains? Pensions was one obvious one you could do, and national insurance for employee contributions is another one. And those are the two that can make the biggest difference in terms of raising more than £5 billion relatively quickly and with certainty. And I think when you look at the current stories in the press, it looks like they've decided that pensions they may do very little on, and instead the focus will be on employer national insurance contributions.
But what impact could that actually have on businesses if that does go through?
Well, effectively, it is a tax on your payroll that you've got to pay. So, the businesses which will be most affected will be the companies that employ a lot of people in the UK. So you could think of, the big food retailers in general, hotels, pubs, restaurants, and it's across the spectrum. It's going to be from the smallest corporates to the largest ones. So it will be, it is an additional cost to your payroll, and coming on top of, the rise we've talked about in wages just now, that will ultimately prove, I think, to be slightly inflationary. Companies will ultimately look to try and pass it on. You'll get some productivity gains over time through automation, changing processes. But if you've got a wage inflation at 5%, you've got another maybe 2.5% on national insurance, then it's very difficult to find productivity savings of 5, 6, 7%. The economy as a whole is struggling to do 1%. And so ultimately, as we saw in the cost of living crisis, companies did pull the price lever to try and offset some of these costs because you have to. And so that, I think, will be what will happen.
And what do you think uncertainty surrounding this budget means for UK equities generally?
Investors don't like uncertainty. So, there is something in the price today for the budget in terms of the risk premium people place on domestic UK assets. And every time you open a newspaper, there's a story about another sector, another tax, what that could mean for you. And we've had a long period since the election of this uncertainty. And I think, for us, the key thing about the budget itself will be we know the day, and it will become a clearing event at which everyone can calibrate. Well, that is, might be bad news for this company that employs a lot of people in the UK, but actually it's not so bad for this sector that we were worried about a windfall tax or whatever. So you'll just get a bit more certainty after that. And I think, when you think of the government's mantra of growth, and more growth, the thing you really need to do is get consumer confidence and corporate confidence improving. And to do that, I think you need certainty. And we saw something, I think, earlier on this week with the commitment to keep corporation tax the same for the whole of the parliament. And I think we need, more statements like that of this is the playing field you've got for the next 5 years. And this is what we're, want to encourage you to invest and grow behind this. And that's, certainly what we'd be looking for from the budget.
Well, one company that certainly seemed quite upbeat was Bellway this morning. Their results were quite upbeat and their shares rose on the back of them. What did you make of those results?
The housing market is following the classic cycle you'd expect with mortgage rates. So mortgage rates today are down significantly from a year ago and very significantly from the time of the mini budget 2 years ago. And affordability, is the inverse of those mortgage rates. So as mortgage rates come down, houses become more affordable. And you're seeing that in terms of Bellway sales rates. And, as we look forwards, if we get the extra cut from the Bank of England, if mortgage rates and bond market expectations continue to be for interest rates to fall through next year, then we'd expect activity in the housing market to pick up. On top of that, you've got a new government that's very committed in terms of their policies, maybe rather than their actions so far, in terms of easing planning, which has been a huge headwind for the house building sector. So we know we've got enormous pent-up demand for housing. We're not building enough houses in the UK. You're now at a stage where affordability is very good versus 2 years ago and is more in line with the average over the last 10 years. Rents are going up, and so for someone who's got a deposit, the desire to own a property rather than rent one remains, it's a compelling proposition.
Ed Legget from Artemis, many thanks for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.